Welcome to vTalkInsight, Market Drivers Daily for December 18th, 2025. Today's markets are being pulled in three directions at once. An AI boom that is hitting funding constraints, an oil market whipsawed by sanctions, and bond markets rapidly repricing a deeper rate cut cycle. Let us unpack how those forces connect across equities, energy, and fixed income. AI remains the main engine behind equity performance, but the narrative is shifting from simple growth enthusiasm toward a tougher focus on funding, competition, and delivery. Capital expenditure plans running into the trillions of dollars are reshaping expectations for productivity, earnings, and even inflation, yet investors are increasingly asking which business models can sustain that investment without overstretching balance sheets. At the headline level, large technology names tied to AI are back in the lead. Company-level guidance points to AI-related spending driving strong revenue and free cash flow, with one major memory producer beating expectations and flagging tight supply and pricing power in high-bandwidth memory. Infrastructure platforms supplying chips, cloud services, and data center capacity are still seen as the clearest near-term winners, even as the wider economic benefits of AI adoption remain in an earlier stage. The strategic reshaping of the AI ecosystem is visible in funding and chip decisions. OpenAI is in advanced talks to raise around $10 billion from Amazon at a valuation above $500 billion, with potential adoption of Amazon's Trainium chips that could cut compute costs materially versus NVIDIA's latest generation. This would diversify OpenAI's dependence away from a single cloud and chip partner, intensify competition in the accelerator market, and potentially pressure NVIDIA's pricing power if more flagship users shift part of their workloads. Beyond pure infrastructure, AI is gradually feeding through to a broader set of equities. Some large U.S. managers project the S&P 500 climbing towards 7,800 next year and over 8,600 by 2027, explicitly linking that path to AI-driven productivity, earnings upgrades, and nominal GDP growth around 3%, above consensus. There's also growing interest in Asian markets such as Taiwan, Korea, and China as beneficiaries of the global AI hardware and supply chain buildout, even though Europe is often seen as having less direct AI exposure. However, the tone is increasingly conditional. Financing stress around large AI infrastructure projects, such as the withdrawal of private credit backing for a $10 billion data center linked to Oracle and OpenAI, has raised questions about debt dependence and the capacity of private lenders to keep funding ever larger buildouts. Concerns about an AI bubble are also visible in the sharp pullback of some leaders, with NVIDIA well off recent highs and technical breakdowns in the main indices, while Chinese AI chip listings trade at multiples far above NVIDIA's, underlining froth in certain pockets. Competitive dynamics add another layer of uncertainty. OpenAI is losing its clear lead as rivals like Gemini and Anthropic narrow the performance gap, and the GPU market is consolidating around NVIDIA and Google, leaving most other chip designs trailing. On the macro side, unprecedented AI-related capital spending, estimated at $5 to $8 trillion, could lift inflation by up to 1.5 percentage points if fully realized, while a sudden rise in interest rates is highlighted as the single biggest risk to the AI equity thesis, even as current expectations for Fed easing support a constructive view into 2026. With AI now driving both growth hopes and valuation anxiety, the next key test will be evidence of earnings delivery outside megacaps and the resilience of financing conditions as we move into a more volatile geopolitical backdrop, which takes us directly to the energy and sanctions story. Geopolitics is once again expressing itself through energy and sanctions, creating short-term price spikes against a still bearish medium-term oil backdrop. The United States has ordered a naval blockade of sanctioned Venezuelan tankers and is preparing additional measures against Russia's energy revenues and shadow fleet, moves that have helped push Brent crude back up from recent 5-year lows towards $60 a barrel. On pure fundamentals, the immediate supply hit from Venezuela is modest. Its exports are a little over 500,000 barrels a day, less than 1% of global consumption, and the oil market remains oversupplied, with prices having dipped to around $55 before the latest rebound. Analysts still describe the medium-term outlook for crude as broadly bearish, expecting oversupply to cap rallies and warning that if sanctions on Russia and Venezuela were relaxed after political deals, extra barrels could put further downward pressure on prices. Even so, the risk premium from sanctions is reshaping sector performance. Energy majors such as Shell and BP are outperforming as higher spot prices feed into earnings expectations, while airlines and shipping companies are under pressure from rising fuel costs. Latin American producers are also benefiting as constrained Venezuelan exports redirect demand, although regional currencies and equities are vulnerable to broader risk aversion when geopolitical headlines escalate. In Europe, the picture is gradually stabilizing. Gas markets are expected to remain comfortable through 2026, with the potential for lower prices by 2027 as new U.S. liquefied natural gas supply comes online, and European utilities are phasing out Russian LNG and leaning more heavily on U.S.-linked investments. Energy companies such as Total Energies are redirecting capital away from Russia and toward the United States, citing trust and political risk, and are unlikely to rush back even if sanctions were eased, reinforcing a long-term rewiring of energy supply chains. Beyond oil and gas, geopolitical tension is evolving in more nuanced ways. Washington now frames Russia and China less as outright existential rivals and more as countries where it seeks a stable, mutually beneficial economic relationship. In recent U.S.-China talks have seen partial rollbacks of tariffs and export controls, even as tit-for-tat measures keep volatility high. At the same time, the U.S. is threatening retaliation over European digital taxes on American tech firms, with a formal investigation raising the prospect of new transatlantic tariffs. While in Europe, defense budgets are rising on the back of Ukraine war risks and NATO spending targets, supporting defense equities. This mix of oversupplied oil, targeted sanctions, and lingering trade friction has clear market consequences. Gold is approaching record levels, and silver has already hit new highs, reflecting demand for hedges against geopolitical shocks and policy uncertainty. While the freeze of Russian central bank assets reinforces the perceived value of holding gold reserves domestically. For portfolios, the key questions now are how far U.S. sanctions on Russia's energy infrastructure will go, whether Ukraine talks progress toward a durable ceasefire that could depress crude further, and how digital tax disputes and Balkan tensions evolve, because each of these can quickly spill back into inflation expectations and, in turn, central bank reaction functions. That brings us directly to the shifting monetary easing cycle and how markets are repricing the path of rate cuts. Monetary policy is entering a more clearly defined easing phase, driven by disinflation and cooling labor data, but with important regional differences and lingering doubts about how far cuts can safely go. Recent surprises in UK inflation and US employment are nudging central banks toward earlier and potentially deeper easing, even as long-term bond yields and fiscal concerns act as a constraint. In the United Kingdom, inflation has slowed more than expected. Headline CPI for November came in at 3.2% year-on-year, below both consensus and the prior month, and monthly prices actually fell by 0.2%. This extends a clear downtrend since September and has led markets to almost fully price a Bank of England rate cut at the upcoming meeting, with expectations for about 69 basis points of cuts by the end of 2026, up from roughly 58 before the data, driving gilt yields lower and sterling weaker. In the United States, the inflation picture is improving more gradually, but the labor backdrop is deteriorating. The unemployment rate has risen from around 4% to about 4.6% by November, a new cycle high, with job creation insufficient to absorb a growing labor force. partly as firms delay hiring amid uncertainty about AI's impact. Markets now price at least 2 Fed cuts by 2026, while some forecasts see the policy rate closer to 3% by the end of next year, as Fed officials signal that well-anchored inflation expectations give them room to focus more on full employment. Policy divergence is an important theme. Several emerging markets have already been cutting rates, while the Fed maintains a more cautious stance and long-term Treasury yields remain elevated due to concerns over fiscal deficits and sticky inflation risks. Against that backdrop, major institutions are reallocating into sovereign bonds, with one large U.S. bank shifting roughly $350 billion from its Federal Reserve account into Treasuries to lock in higher yields ahead of expected cuts, contributing to strong year-to-date gains in broad fixed income indices and reinforcing support for safe havens such as gold. Disinflation drivers extend beyond monetary policy. Goods prices are expected to soften further in the U.S., and especially in Europe, helped by China exporting deflation through cheaper exports, ongoing deregulation, and permitting reforms that should lower energy and housing costs over time, and modest expected declines in U.S. existing home prices. At the same time, AI-driven productivity gains and fiscal expansion are underpinning upgraded U.S. growth forecasts around 3% for the coming year, with core personal consumption expenditures inflation projected to slow toward 2.5% to 2.6% by the end of next year, but not quite reach the 2% target. The counterargument is that inflation may prove stickier than markets hope. Massive AI-related capital spending, estimated at up to $8 trillion, combined with fiscal stimulus, could add roughly 1.5 percentage points to inflation if fully realized, while still elevated long-term yields show investors are not fully convinced that central banks can ease aggressively without reigniting price pressures. For portfolios, that leaves a narrow path where rate cuts support small caps, housing, and credit without undermining inflation progress, making upcoming Bank of England decisions, U.S. labor and core inflation prints, and the choice of the next Fed chair critical signals for how the easing cycle will actually unfold. Across markets, 3 forces stand out. AI remains the dominant growth and equity driver, but funding strains, rising competition, and valuation questions are turning it into a selective rather than universal tailwind. Geopolitics is injecting a fresh risk premium into oil and defense, while keeping safe havens like gold in demand, even though the underlying crude balance still looks comfortably supplied. And in rates, disinflation and softer labor data are pushing central banks further into the easing cycle, with the UK leading and the US moving more slowly, all against the backdrop of higher long-term yields and fiscal constraints. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.